Hello and welcome. Have you taken appropriate steps to protect your family if you can't provide for them? In this on-demand webinar, OJM Group Director of Financial Planning, Michael Llewellyn, discusses the importance of a death benefit needs analysis for any life insurance policy you are considering or may already have in place. He notes the general guidelines may not apply to high-income earners and provides a sample death benefit analysis. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. We'll discuss how you can get a free ebook download or hard copy of Wealth Management Made Simple or any of our other books.
Thank you for joining us. My name is Michael Llewellyn. I'm the Director of Financial Planning at OJM. In this video, we are asking the question, have you taken the appropriate steps to protect your family in the event you can't provide for them? And if you feel like you have you had an analysis done to confirm that? We're going to look at how to determine how much protection you need, meaning how much death benefit via life insurance. There are many rules of thumbs that exist, but like most rules of thumbs, those are applicable to the masses, not high-income earners. And if you follow the masses in this situation, if you're a high-income earner, you may end up being overinsured. We're going to walk through a true needs analysis for a high-income earner. And when we start this analysis, you're really looking at three areas. Today we're going to focus on two, but I'll mention all three. Lump sum amounts, so as you'll see, that's going to be your mortgage, student loans, things that you have an immediate need to be covered. Capital for annual income, so for your surviving spouse and children income. Estate tax could be a need for death benefit. In this situation, and the way we're discussing it today, it won't be applicable. But if you are an individual that's not married, that has a net worth of over $11 million, it could be an issue for you. If you are a married couple and have a net worth that's over $22 million, then it could be an issue for you as well too. And obviously the estate tax laws are always changing, so it very well could be an issue for many more of us in the future. But today we're just going to focus on true protection need. Lump sum. So when we say lump sum capital needed, what we're really talking about again is just the immediate need. So we're using a 40-year-old married couple, both are 40. In this situation, we're saying that an immediate need would be for burial expenses. That's a traditional one. Obviously not a large expense here, but one that generally is included, may not be needed in your situation. Debt elimination, this is generally the largest. So mortgage, so if you have a mortgage, if you know what your mortgage is, that amount needs to be included in there. Any outstanding personal loans, lines of credit, student loans, depending upon your type of student loans, could be included in here. Really just anything else that you have outstanding. And then education funds. And when we say education funds, we're talking about college savings for your children. Obviously, how you want to save, where you want to send your children, how many children you have can affect this number and can drive it up or down, obviously. In our situation, we're just using $200,000. So you can see total lump sum needs in our analysis here is $730,000. So we say immediately when something happens, and immediately being once you're able to, your spouse passes away and receive the death benefit from the insurance company. These are the things that are being taken care of in the short term. Capital needed to meet annual income needs. This is a part of the calculation that can really drive up the overall death benefit need. So you can see we break it up into three different time periods. So until your children are self-supporting, after your children are self-supporting, but before retirement, and then during retirement. And they really can, vary by individual. In this situation, you can see we just have children would be self-supporting in 15 years. So we're saying that the need on an annual basis is $96,000. Now, again, this is net to the spouse. So in this situation, we're determining that's what they need. This is after taxes have been taken into account of as well too. And we will look at some of the assumptions that we're making to get to these numbers on the next slide. And then after the children are self-supporting, the needs may still be a little bit higher. Generally, is what we see. So we have it a little bit higher for about 20 years, and then for 15 years, the tail end, we have it at 60,000. So essentially, the total income needed in this situation is 50 years. Again, both spouses are 40, so you would need to provide income for that amount of time. Now, obviously, there are situations some may say, well, what if I live for 10 more years? Your need theoretically would decrease. What we often see, though, is the need shift in other places. Maybe debt goes up, that type of thing. Very important point here, we're using the capital depletion method, and what that means is there won't be anything left. So we're trying to work to zero there. And you can see we total up each individual time frame there, and the next couple slides will total that up to determine overall need. So the assumptions that we're making on capital income needs, we're just assuming that you're earning a 6% rate of return on that money. So we're backing in to a number that we need to produce that income, and we're assuming that you can earn 6%. We're assuming the average tax rate is 25%, and then inflation at 3%. Clearly, if you move any of these variables one way or the other, that can increase or decrease the overall. We thought it was important to show how we came to the numbers that we needed from a capital income perspective. So you can see here, we're getting to adding it all together. The lump sum need of 730, capital needed for annual income 2.7 and change, which leads us to total capital needed upon death of 3.5 million. Now, obviously, you have other assets, or you could have other assets. And in this situation, our couple does. They have liquid assets of 600,000. This can be retirement assets, so your IRAs, your 401ks, your taxable account as well too. Also, if you have some life insurance, so for example, hey, I already have $1 million life insurance term policy, we could back that out as well too. So your need, would obviously go down by that. In this situation, we're just looking at current assets to reduce overall capital needed upon death. So you can see what that leads us to is total death benefit need of 2.9 million. A lot of situations, for clients, again, we talked about the rule of thumb earlier. For our clients that are earning higher incomes, obviously, that can really drive up what the death benefit would say that they need. And really, what we tell clients is we need to back into that specific number to make sure we're insuring the right amount and being as efficient as we can. How to address the need? Term insurance is really the best option in this situation. It doesn't mean that there can't be use of other permanent insurances for other longer term needs, but if you're in your 40 to 50, even mid 50 range, term insurance generally can be the best option there. There's different terms. You need to determine what's your term, how long you need that death benefit for, and that's something that we talk to clients about. If you have a large need, we look at using a laddered term approach. What that means is we may buy different policies for different terms, so a 10-year, 20-year, and 30-year different policies for different amounts. I just wanted to give an example of what $3 million of coverage would look like for average to slightly above average health. A preferred rating is by no means the best rating, or assuming unbelievable, phenomenal health. For a male, it's going to be right in the $2,100 range. For a female, you can see there almost $1,800, and that's a fixed premium for the duration of that term, that situation. So you can see, depending upon where you are, obviously if you're 45 years old, the cost is going to be more. If you're 50, it's going to be more. If you're 35, it's going to be less, assuming the same health. So next steps, review your current coverage. Do you have the right amount of death benefit in place would be obviously the first question, but then also if you do have current coverage, does the term that's on it match up with your current need? And we have clients that come to us and say, well, I've got some term policy in place that I bought 10 years ago, but I've also just had a 2-year-old. So your need is longer than 10 years. So we need to reevaluate what your overall need looks like from a term and from a death benefit perspective. Also, at OJM, we would be happy to run this specific analysis for you and to see, really determine what is your true need and are there any adjustments that need to be made, and can we be a resource there for you. And that's something that we would be happy to do, and we appreciate the opportunity of being a resource for you and look forward to speaking with you in the future.
OJM is a multidisciplinary wealth management firm, and we work with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by texting OJM Web to 555-888. You can also visit ojmbookstore.com and enter the code OJMWeb at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.